Most of us grow up believing that banks simply hold our money like a vault, a storage box, a safe place. But the truth is far stranger and far more important. Because in our modern system, most of the money you think exists doesn't exist at all. It isn't printed, it isn't stored, it isn't sitting anywhere. It's created the moment someone takes out a loan, and it disappears when the loan is repaid. This is the banking trick everyone forgets. Money is not a thing, it's a promise. And every promise changes the world we live in. Once you understand how banks actually create money, the economy stops looking random. You start to see why prices rise, why debt grows, and why some people always seem to end up ahead, no matter what the rest of the world is going through. Today, we're going to uncover how the system really works. If money is created when banks issue loans, then those who receive that new money first have a very different financial reality than those who receive it last. This is why housing prices can climb faster than wages, why the cost of living rises even when people are working harder, and why wealth seems to pool in the same places year after year. This isn't just an economic concept, it shapes our daily lives. Understanding this changes how you see your salary, your savings, your debts, and even your future. Because once you realize how money enters the system, you begin to understand who benefits and who gets left behind. To understand the banking trick, we need to go back to a time before digital payments, credit cards, or even paper money. In the Middle Ages, merchants and wealthy families stored their gold in the vaults of goldsmiths, people who already had secure safes and guards. In return, the goldsmiths issued paper receipts confirming how much gold each person had deposited. These receipts became easier to carry and trade than the heavy coins themselves, so people began exchanging receipts instead of the gold. Soon, the receipts became more important than the metal they represented. Gold hardly moved at all, only the paper changed hands. Then came the realization that changed history. Most people never came to withdraw all their gold at the same time. So the goldsmiths began issuing more receipts than the gold they actually had. They lent these extra receipts out and charged interest. The gold remained in the vault. The receipts, promises of gold, circulated as money. And as long as no one asked for all the gold back simultaneously, the system worked. This was the first form of fractional reserve banking, holding only a fraction of the money promised. Over time, banks replaced goldsmiths, governments standardized currency, and central banks added layers of oversight. But the core principle never changed. The system still operates on promises, trust, and the assumption that not everyone will ask for their money at once. This is the forgotten origin of our modern financial world. Money didn't start as wealth. Money started as a claim to something else. And today, those claims are more abstract than ever. So how does this trick work today? Let's strip away the jargon and make it simple. When you walk into a bank and take out a loan, whether it's for a house, a car, or a business, the bank doesn't go to a vault and withdraw money to hand to you. It doesn't take someone else's savings and transfer them to your account. Instead, the bank creates the money by typing numbers into your account balance. That's it. New money isn't printed, it's entered. The bank records your promise to repay. That's an asset to them. Then they place the same amount in your account. That's their liability. 2 numbers, 2 entries, 2 sides of a ledger. No physical money moved. No one's savings were touched. But the total amount of money in the economy just increased. This is why money is created as debt. Every new dollar begins its life as someone's promise to pay it back. And when you do pay it back, the money doesn't return into circulation. The bank deletes it. The promise is settled. The money disappears. But here's the part that matters most. The bank keeps the interest. The money you repay plus the additional amount you owe for borrowing, that portion does not disappear. That is the bank's income, created from nothing more than your agreement. So the world's money supply expands and contracts based on loans issued and loans repaid, not based on printing presses or vaults filled with cash. The system runs on confidence, credit, and constant circulation. It works until too many people stop borrowing or too many try to withdraw at once. Then the illusion cracks. Today, this system is more digital, faster, and more invisible than ever. Banks no longer rely on paper money, gold reserves, or even physical cash movement. Most of the money in the world exists only as numbers on screens. Around 92 to 97% of global currency is digital credit, not physical bills. When you swipe your card, send a wire, or tap your phone, no one moves anything. Banks simply adjust balances within a shared system of IOUs. And because banks are allowed to lend far more than they actually hold, the system requires constant borrowing to stay alive. If loans slow down, money creation slows down. If people begin repaying debts faster than banks issue new loans, the money supply shrinks. That's when recessions happen. Not because factories stop working, not because people stop needing goods or services, but because the oxygen of the system, credit, stops flowing. So governments and central banks step in. They lower interest rates to encourage more borrowing. If that's not enough, they inject new money into banks, hoping it will trickle through the system. But here's what they don't say. This new money does not reach everyone equally. It flows first to banks, financial institutions, corporations, investors. They use it to buy real estate, stocks, and commodities. Prices of assets rise long before wages do, which means those closest to the money gain first. Everyone else pays later, through higher rents, higher prices, and higher cost of living. This is not an accident. It is the system functioning exactly as designed. If this system affects everyone, then why don't most people know how it works? Because over time, banking was intentionally made complicated. The language shifted from simple ideas, like loans create money, to technical terms like capital adequacy ratios, reserve requirements, and liquidity operations. The complexity creates distance, and distance creates trust without understanding. Most people are taught to think of banks as storage vaults. You deposit money, they hold it, and you withdraw it. This image feels safe, familiar, reassuring. But that picture hasn't been true for over a century. Schools don't teach this. Most economists gloss over it, and mainstream media reduces money to slogans like "work hard and save." Meanwhile, banks profit when you borrow. The system depends on your debt, and the rules are written in a way that keeps the mechanism out of view. It's not a conspiracy, it's incentives. A system that relies on confidence must maintain a certain illusion. If everyone suddenly understood how money is actually created, they would realize saving alone is not enough. Working harder is not enough. Understanding how the system works, that is the advantage. So what does all of this mean for you, right now in your real life? It means that money is not just something you earn. It's something that is created and distributed in a way that shapes opportunity. If money enters the system through loans, then those who borrow strategically often gain more leverage than those who only save. If new money flows first to assets, then owning even a small piece of appreciating assets can place you on the right side of the system. Here's the key shift. Working harder doesn't change your position in the system. Understanding the flow of money does. This doesn't mean you must take on reckless debt. It means seeing money as a tool, not just a reward. For example, instead of saving endlessly in weakening currency, store value in assets that benefit from inflation, like shares in strong companies, real estate, or commodities. Instead of viewing debt as something to fear, understand that productive debt, used to acquire assets, education, or business leverage, can place you closer to where money enters the system. Instead of asking, "How do I make more money?" ask, "How does money move? And how can I position myself earlier in that flow?" The goal is not to beat the system. The system is too big. The goal is to stop being downstream, where money loses value by the time it reaches you. Because once you recognize how the banking mechanism redistributes wealth, financial decisions become intentional. You stop playing defense. You begin to play strategically, and that shift alone can change your trajectory. Let's turn this understanding into something usable, something you can apply starting today. 1. Don't store all your wealth in cash. Cash loses value over time, especially in a system where new money is constantly being created. Hold some cash for stability and emergencies, but store your long-term value in assets that tend to rise with inflation. This could include broad market index funds, real estate, or REITs commodities like gold, or any asset that benefits when the money supply expands. Even small, consistent ownership compounds over time. 2. Avoid consumer debt, but understand strategic debt. Debt used to buy things that lose value traps you. Debt used to acquire things that gain value, education, business tools, investments, can move you closer to where new money enters the system. The key is purpose, not fear. 3. Pay attention to where new money flows. If governments print money and direct it toward real estate, prices rise, stocks, markets rise, defense stocks rise, green energy tech rises. You don't need to predict the future. You just need to watch policy and position early. 4. Think in terms of purchasing power, not just income. A raise means little if rent, food, and healthcare rise faster. The real question isn't how much do I earn? It's how much can my money still buy? Understanding this shifts you from chasing dollars to protecting and building value. Because in a system where money is created, not found, knowledge is leverage. We grow up thinking money is simple. You work, you earn, you save, you spend. But that's not the whole story. Money isn't just earned, it's created. And the place where it enters the system shapes everything that happens next. Some people are positioned near the source. They receive money before prices adjust. They buy assets early. Their wealth compounds quietly. Others receive money later, after prices have risen. After opportunity has moved, they run harder, only to stay in the same place. This isn't about intelligence or effort or morality, it's about structure. Understanding that structure doesn't instantly change your life, but it changes the way you navigate your life. You stop thinking in terms of working harder. You start thinking in terms of positioning. You stop asking, why is this so unfair? You start asking, and where does the money enter? And how close can I get to it? And that question is powerful, because once you see the system, you can no longer unsee it. You begin to act differently, save differently, invest differently, build differently. The game hasn't changed, but now you're playing with the rulebook. If this expanded your perspective, there's more to uncover, because this is only one part of how wealth is created, stored, and transferred. We're just getting started.